The Federal Reserve is cutting interest rates by 0.25% for the second time in 2 months. Local 5's JD Snover is in studio with how we got here and what the news could mean for your wallet.
Yeah, that's exactly right, Stephanie. The Federal Reserve announced earlier today that it's reducing that rate it charges banks to borrow money. But local economists I spoke with say it could be a bit of a gamble. With the government still shut down, the September jobs report wasn't released, meaning the Fed had to make this decision without a full picture of where things stand.
It's interesting to think of the Fed basically flying blind.
That's how Iowa State Economics Chair Peter Erasm says the Federal Reserve's latest rate cut was made without key economic data and under political pressure.
They're having to guess as to what's really happening with the U.S. economy, in part because the information that they have is at least 4 to 6 weeks old.
The Fed's legal mandate is to keep inflation low and unemployment down. But without the September jobs report, which was delayed by the shutdown, that gets harder.
They have a balancing act, and it's difficult to do. They've been doing very well, of course, in the last decade or so. But the situation is much more complicated now.
What is available is inflation data. The consumer price index rose to 3% nationally in September, a full point above the Fed's target. And here in Iowa, it's even higher. A report from the Common Sense Institute shows Midwest inflation hit 3.1%, with Iowa households spending over $1,200 more per month than they did in 2020 to maintain the same standard of living. So why cut rates when higher inflation's in play? Economists say it's a trade-off aimed at supporting the job market.
They're risking some upward pressure on prices, but at the same time, they're making it a little bit easier for consumers to purchase goods and services, which is going to show up perhaps in increasing demand for workers.
Now, this is a top-of-the-chain decision, meaning there won't be an immediate impact on kitchen table finances. But ripple effects could show up in things like car loans, since banks may pass along some short-term savings to those car manufacturers, Stephanie.